Well, the amazing thing is I actually started off, for most of my life, I wanted to be a chef actually, and I was a chef in Italy, and I realized that I wasn't a very good chef, and I wanted to try other ideas, and I wrote a letter to lots of various chief executives in the financial services industry. One of them was kind enough to give me some free work experience, and I started as a stock analyst within Gerard Asset Management, and it turned out that I really enjoyed it. I liked it. I liked meeting companies. I liked meeting, looking at markets generally. I just found it interesting, and the people I got to meet, it really kind of, it fired me up, I guess. Yeah, I mean, generally, it was a big step up for me, obviously, and one that I was delighted to take. I wasn't necessarily expecting it. And there was a huge amount of information and responsibility to assimilate. But it is something that I'm really, really enjoying. I'm enjoying the responsibility of being able to set the investment direction for the business and really try and set the direction for portfolios in general. Whereas previously I was more responsible, say, for the tactical portion of the portfolio, I now get much better discretion over sort of how the overall portfolios look. Well, there's a couple of angles here. I mean, I think, again, you split the portfolio up into two sections. The big section really is the strategiat asset allocation, and that's an exercise in humility. You're really just trying to sort of organize a group of assets, and we have a quant team who do something called resampling, and they look at hundreds of thousands of different plausible futures, and they try and find the portfolio, the mix of assets that best sort of takes the opportunities that they see out there and best defends against some of the risks. That's the large part, and that should, like I say, that's just stay there. It doesn't necessarily change that much. You're not trying to take account of economic cycles. Now, on the tactical portion of your portfolio, which is a much smaller bit, what you're really trying to do is be a bit more agile. And as you get towards the latter phases of the economic cycle, the thing that's really interesting is that emotion plays a greater part in markets. People obviously, particularly after the kind of recession we saw last time, people are very keen, investors are very keen not to be in the way of that kind of downfall again. And that means that a few times in the last few years, you're seeing that investors aren't necessarily sort of assessing incoming information and data as dispassionately and objectively as they might want. That gives opportunities for the tactical portfolio to act in the opposite direction, to find little ways of adding value relative to that benchmark. Well, emerging markets in general, and particularly emerging Asia, is a really interesting area. One of the things that's going on there is, in terms of investment and investment sort of generally, what you're looking for is countries with credible macroeconomic policies, deep and liquid markets, diversification offer, all those kind of things. In Asia, you've got quite a concentrated mix of technology and other quite interesting areas. And it's an area, obviously, where the population story is incredibly interesting. That's the area where in 10 years' time, you're probably going to see, the areas, the region's contribution to the world's population start to be matched by its contribution to the world's stock and bond markets in terms of market capitalization. And if you look at it, Asia only contributes, I think, over half of the world's population. At the moment, it's only about 10% of the world's stock and bond market. So on a strategic time view, that's a very exciting opportunity.